Hello, everyone, and welcome to our April webinar session, Tariff Talk, Perspective and Actionable Insights. My name is Tom Bittinger. I'm with the marketing team here at Wealth Enhancement Group. And before we get started, as always, just want to go over a few housekeeping items. One, there will be a Q&A session at the end of this presentation. So I'm sure we'll have a lot of questions, so feel free to use the questions pane on your GoToWebinar menu, and we'll get to as many of those as we can. Anything that we do not get to, we will pass along to your advisor, and then they can follow up with you personally. And then, of course, we will also be recording today's session. So look for that in your inbox either tomorrow or early next week. It will also be on our YouTube channel, where, again, we also have a lot of other great video content as well. So with that, again, we've got a lot to get into. Joining us today are Gary Quinzel, VP of Portfolio Consulting, and Aya Yoshioka, our Portfolio Consulting Director of Los Angeles. Gary, Aya, I know we've got a lot to get into, so Aya, I will hand it off to you.
Thanks, Tom. Really appreciate it. So we know 2025 has been a challenging year so far in markets, and the hottest topic that is crossing everybody's headlines is just tariffs. We have so much coming across our desks when it comes to tariff talk that we thought this would be a great chance to just go back and do a little bit of a history deep dive into what are tariffs, how have they impacted us in the past, and how could they impact us in the future. So with that, Tom, if you could move to the next slide. We just want to make sure that everybody's aware of what a tariff is. A tariff really is a tax or duty that is imposed by a government on imported or exported goods. We have a long history of having tariffs in this country, and then global trade definitely had a lot of tariffs. And tariffs have always been a part of a lot of global trade that we've had. The first major piece of legislation in the US was the Tariff Act of 1789. So bear with me while I go through this history lesson here. But during that time, up until 1860, 80 to 95% of the federal revenue actually came from tariff revenue, not income taxes. And so it wasn't until the 16th Amendment was passed in which we started to actually tax income tax, that the federal revenue switched over a little bit more to income tax revenue versus tariff revenue. If you go to the next slide, a little bit more history in terms of some notable tariff acts that we've had to go through. So the Tariff Act of 1816, this happened after the War of 1812. Again, never really thought I'd be talking about the War of 1812 in an investment-related, webinar here, but here we are. And during the War of 1812, there was a lot of, obviously it's a war, and afterwards, we had industries that were in disarray. And when it came to a global perspective, a lot of countries were taking advantage of that, and so their goods were cheaper than what we were able to manufacture sort of here in the US. And so in order to protect some of our emerging industries, a lot of them were in textiles as well as iron, we placed tariffs, and they were as high as 25% in terms of the tariffs that were imposed upon global trade. And during that time, it actually favored a lot of our domestic manufacturing and actually helped economic growth during that time. There was a little bit of difference in terms of the benefit was a little bit more to the northern states versus some of the southern states, despite those protections on things like cotton. But that's sort of one example of when tariffs were actually a little bit more positive, I think, to the overall economic growth engine of the United States. If you go to the next slide, I think the one that most of us are most familiar with when we talk about tariffs is the Smoot-Hawley Tariff Act of 1930. So this happened during the midst of the Great Depression, and the average tariff rate went from 13.5% to 20%. And again, the idea really was to protect American jobs and American industries, but it led to retaliatory tariffs from other countries and really caused a significant decline in global trade and worsened the overall impact of the Great Depression. And so, from our standpoint, could this be another repeat of, the Smoot-Hawley Tariff Act? I think we can always look back in history and see the differences and see, where there are some similarities and where there might be some differences to see whether or not we would see the similar impacts or not. So with that, I'm going to turn it over to Gary to talk more about what's going on in 2025 as it relates to tariffs.
Thank you so much, Aya. Yeah, like you said, here we are. We didn't necessarily expect to be in this situation that we are today, and we have learned a lot, from history. And I think it would also be helpful just to kind of look at just the last, few months ever since the inauguration, what has transpired, because there's been no shortage of, headline events coming out of Washington. On the next slide, we have a little bit of a timeline that just kind of calls out some of the, more consequential events that have happened ever since, President Trump was inaugurated, and even before the actual, going back to the election in November and prior to that, there was a lot of talk. There was plenty of precursors about the potential for tariffs, and we know that President Trump is a believer in using this as a tool, potentially as a negotiating tool, but also as a mechanism to help bring back American, jobs, manufacturing jobs, which have largely, as many know, have been displaced over the past several decades, for a variety of factors. We know that globalization, offshoring has been a big part of that, but we also know that, automation, and different robotics and other changes in factories have changed the very use case of workers. And we've also seen a lot of relocation of workers from northern states to southern states. So there's a variety of factors, political factors, demographic factors, and of course, labor force factors that have gotten us to where we are today. And going back to this timeline, we can call out some of those specific events, starting on February 1st, when we got the initial announcement about those tariffs that were going to be imposed on, our neighbors to the north and south, Mexico and Canada, and of course, China as well. But we've had a lot of back and forth, and that's caused a lot of uncertainty, for the markets. And as many of us know, the market really does not like uncertainty. It's that clarity of knowing what the policy is going to be for business leaders, for people that are in positions to spend money on CapEx. When you don't know whether a policy is going to be in place for a prolonged period of time, that's one of the main reasons that we're seeing, the volatility that we're experiencing today. And so, you flash forward, we've seen some of the back and forth. We saw the tariffs on Chinese imports double. We saw, steel and aluminum tariffs go into effect at 25%. But of course, the big news came on Liberation Day, when those reciprocal tariffs were first announced. And that's really when the market started to materially decline. And I know Aya's been talking some more about some specifics about some of the market stats thus far. But, fortunately, we have had, once again, a little bit of a pullback on, I believe it was April 9th, President Trump announced kind of a somewhat of a 90-day pause for some of those countries that had indicated a willingness to come to the negotiating table, with a very notable exception. China has not come to the table. Now, as of recent days, there's been a lot of rhetoric back and forth. Maybe we did negotiate with them, maybe we didn't. There's still not a lot of truth or clarity around that. But if we go to the next slide, we have a pretty good visual that just demonstrates, what those reciprocal tariffs are looking like as of today, right? Here we are in the middle of April. And like I mentioned, China still has that high reciprocal tariff rate, over 120%, whereas all those other countries got that 90-day pause. It went back down to that 10% base level. So it is still extremely high, right? This is still a much notably higher overall tariff level than what we've had in many, many years. And we have a future slide that's going to demonstrate that. But I think the real question that's, again, causing that uncertainty is that, we just don't know where tariffs are going to go. We do know or believe that, with higher tariffs, generally speaking, it should be more or less a one-time inflationary shock, but markets will adapt to that level, right? It's not like they're going to continue to go up at that same set percent on a yearly basis. We're resetting the global trade policy as we know it, if it's fully implemented as of today. You can see here on this chart is that if these tariffs continue to go through as they are currently being proposed and set to be implemented, we're looking at an overall tariff rate that's in that 28% range, and that is higher than the Smoot-Hawley Tariff Act that Aya talked a little bit more around the Great Depression. So this is a substantially higher level than what we're used to, back to period when, as Aya mentioned, the U.S. economy drove a lot of its revenue from tariffs, which just hasn't been the case for a very, very long time. If we go forward one more slide, there is just another demonstration. I'm sorry, I thought we had one more. I apologize, but the takeaway from my last slide was that we're at a much higher level than what we've experienced in quite some time, and the market can adapt to this. But the challenge right now is just not knowing where we're going to go next and what we're going to see on an ongoing basis. And so I'm going to hand it back to Aya. She's going to talk a little bit about what we've experienced in the last couple of weeks. There's been a lot of volatility, and certain asset classes have performed better and worse than others. So Aya, why don't you walk us through that?
Thanks, Gary. Appreciate it. So, as much as we'd like to make sure all of our slides are up to date to the most latest and greatest numbers, these, it's been really tough. So we tried to, get the numbers through the middle of April so that, really incorporating some of that volatility that we saw in early April with markets really, reacting to all of the reciprocal tariffs and the, self-imposed Liberation Day from President Trump. And as you can see on this table, you can see that month to date for the first 2 weeks in April here, it's mostly red. And, it's not too much of a surprise now. I'm sure many of you have been watching the news here. But, one of the things that I think has been a little bit more surprising has just been the impact of US stocks relative to international stocks. I think for several years, almost, the last 10 years, international stocks, emerging market stocks have really underperformed US stocks. And so in the short time frame here of the last month or so, and especially even, more so when you look at that year to date column in the middle, you can see that international stocks have actually done really well so far. And, one of the things that we've observed during this time is that, we've had some strange correlations going on in asset classes in markets. We saw stocks go down, we saw bonds go down and yields actually go up, especially on the long end of the treasury curve. And then we also saw the US dollar go down. And so we had a lot of narrative in markets talking about how much it is really just a referendum on anything US. And so anything risk related and US related was being sold during this time. So I think that's a reflection of what you're seeing here on the performance numbers. And, I think one of the things that everybody else has probably pointed to is the one thing that has actually performed well during this time has been gold. And even though it's not on this chart here, and you can see the Bloomberg Commodity Index, which does include some gold, but it is predominantly, weighted to energy. So crude oil and all of the, energy components there, energy products, they're actually down because at the same time this has been happening, we've had an announcement about increased energy supply, increased oil supply from OPEC. And so, the sort of shiny gold performance really sticks out, I think, during this time versus anything else. But, you know, as things start to get better, perhaps gold will lose some of its luster, at least as things stabilize in the future. If you go to the next slide, yeah, go ahead, Gary.
Sorry, I apologize. I think it's worth calling out that gold was definitely on a secular trend for quite some time. So this is not necessarily just like a perceived flight to quality, which is what some might think. And to some extent, it might have some level of truth to it, but it's been going on for quite some time. And I think there's some other dynamics that have been happening, such as central bank purchases of gold in lieu of other treasuries and other securities. And so I think there's a bigger picture story to it that's been exacerbated in recent weeks. Worth calling out though, because we are getting a lot of questions about, you know, how much longer this, you know, gold rally can run. And I would point to some of those longer term trends where you know, gold has seen a lot of strength, and a lot of it has to do with some of that kind of central bank buying.
Absolutely. Great point there. Tom, if you go to the next slide, here we are. It's another way to sort of look at everything that we just sort of talked about. The prior slide, you saw all of the individual components there, but this is a nice way to look at it from a, you know, overall standpoint: growth versus value, core, large cap, mid cap, small cap, US versus international. And you can see the different time frames that we have here. And the one thing that this slide shows that the other one didn't is a little bit longer term performance there. So the 3-year returns over to the right are included. And you can see when you look at it from a very longer term perspective, US large cap growth has still been the place to be. Now, is that changing? Those are some of the conversations that we continue to have on our investment team, whether or not, you know, that run is coming to an end. Perhaps not, right? There's still parts of US large cap growth when it comes to technology and things like that that may still have another leg in the future. But on the flip side, you know, US small cap value, US value stocks have actually done relatively okay when you look at things at different time frames. And then again, as I mentioned earlier, the US versus international, you can really see that those differences when you look at some of the shorter term returns, that 1 month number, especially international being only down 0.5% versus the US down 3.8%. Emerging markets only down 2.7. And so, you know, that's the shorter term returns that you're seeing there versus some of the longer term returns that you've seen in the 1-year and 3-year numbers, in which the US has shown more robust numbers there. If you go to the next slide, another way to sort of look at some of the more recent performance here is in this chart. We're also showing calendar year performance, as well as the cumulative 5-year return on different indices, as well as the 60/40 portfolio, both domestic and global. So, you know, you can see on the first line in the table over there, you see that the 5-year return for a 60/40 portfolio, just using the S&P 500 and the Bloomberg Ag, has returned 51.5% over the last 5 years, really strong. But you see over to the left, those year-to-date numbers and, you know, second quarter to date, as well as the first quarter numbers being negative, which has been tough. But when you look at those same numbers globally, right, those 5-year returns, so the second line there, the 60% in the MSCI All Country World Index and 40% in the Bloomberg US Ag, you can see that the 5-year return has been 32.9%. And more recently, again, that Q1 return was positive. We're seeing that, but it was negative for the second quarter to date through middle of April, and then 2025 also negative through April 15th, but a little less so than just the purely US 60/40 portfolio. The other thing that we note here is just key observations about, you know, where the S&P was from that February 19th high. The S&P was down 12.2% through mid-April. The NASDAQ dropped obviously a little bit more. It's more tech heavy, and that's where people sold first. Some of their winners were sold first. So that one was down 15%. And, we also have the table here that shows what worked and what didn't. And as we mentioned before, some of the things that, did work: gold, international, bonds actually did well initially, even though we did see some squirrely action on the long end. And then, value did outperform relative to growth. Again, those winners were being sold. And what didn't work was small caps. Again, risk off environment, tech, selling your winners. Muni bonds had some squirreliness around them as well. There was a lot of additional supply that came on in muni bond land, and there was some fear that some of the protections that muni bonds have were going to perhaps go away, especially as the support in terms of federal transfers to state would start to decline a little bit. And then I've talked about the US dollar, having gone down during this time as well. Gary, anything to add there?
I think you did a great job covering that, and that's a good segue into the next slide, which talks a little bit about sectors, because we get a lot of questions about, we get a little, getting a little more granular, what's working, what's not. And I think it's really interesting that we've seen a rotation from the winners of the last couple of years into some new sectors. And so maybe just dive into that a little bit.
Yeah, thanks for that. So as you can see, in this chart, and I think everybody knows that tech has been a darling of the US equity market. It's been, we've talked about the Mag 7 many times. There's, NVIDIA, Microsoft, Apple have been, tremendous drivers of the overall US equity market and, key contributors to the S&P 500 over the last several years. And you can see that in this chart where, tech has seen tremendous performance, whether you go back to 2020 where it was up 44%, or in 2023 where you saw, a almost 58% return. On the flip side, I think energy has had a rough time during these last 5 years. Some of these value sectors where energy was down, 33.7% in 2020. I think everybody remembers it was actually around this time in which crude oil prices went negative during the 2020 year during COVID. And you've seen a little bit of a rebound so far, but not too much. And again, like I mentioned before, crude oil is actually down quite a bit as supply has increased, and the expectation is for demand to be, subdued as we go through this year, just given all of the uncertainty that is surrounding global trade. Utilities is another area that gets a lot of attention, just given the tangential sort of, association with technology. So all the AI that is going to sort of come about really needs to be powered by utilities. And so there's been a sort of new sense for utility stocks. They're also a little bit more defensive in nature, so they've actually performed relatively well in 2025. Anything else that you'd call out there, Gary?
I think you summed it up well. I mean, just to summarize, the historically defensive sectors are staples, healthcare, and utilities. And not that we drew it up this way, but look at what's actually positive relative to the big winners. And I think it's worth calling out just how the numbers work. We get caught up with the really big returns in infotech of 36% in 24 and 58% in 23. But when you lose 14%, that's a pretty big number because if you lose a certain percent, it takes more to get back to where you were. And so these are big numbers, big declines for consumer discretionary info technology for those that kind of chase returns kind of towards the end of the cycle. This is where those lessons about diversification and not getting over your skis really come into play here, because this is why we don't we focus on valuations, and we focus on making sure our exposures are really spread out for this exact reason. And so this is just another great example of diversification in action, and why we take the approaches that we do in our portfolios.
That's a great point. Tom, if you go to the next slide, I think this is just one more way of showcasing the overall market performance over the last 5+ years here. I think during times of volatility, it is nice to zoom out a little bit and kind of really look back at where we've come from. And so again, as I mentioned, 5 years ago, we were going through COVID and the pandemic, and markets were in turmoil back then as well. And it's great when you kind of forget some of that turmoil, especially when you've had such great returns since then. And you can really see that in that dark green line there. That is the S&P 500, so the equity market there. And then you see the bottom line down at the bottom. That is the U.S. Ag, which represents the bond market. And bonds have been steady. They had a tough 2022. We all remember 2022, and they actually you can see the blue line there coming down below zero. But over this 5-year time frame, they've been relatively steady. And so therefore, in a 60-40 portfolio, that middle line, that orange line there, it's actually returned. It's been a positive experience, I hope, for most investors in a 60-40 portfolio. And with that, I'm going to turn it over to you, Gary.
Thanks, Aya. I'm going to take us through some kind of concluding slides here, because we're getting asked by a lot of clients, what should I do now, and how should I, think about, the current market environment, especially from a longer term perspective. So on the next slide, this is going to sum up a bunch of busy charts. I apologize, but I'll do my best to kind of walk you through what all they mean. But we have a lot of data, a lot of academic studies that point to some of these facts, that the first year of a new presidency often does bring market turbulence and changes in policy. But despite those policies, we know that the market is resilient. We know that the factors themselves are different, and we always think that this time is different. And but over the long run, we have a lot of different examples of volatile changes, shifts, geopolitical events, things that have rattled markets, caused a lot of uncertainty, and yet over time, the market does seem to find a way to resolve those issues, establish new norms, and kind of move on. And so, what's really important is having kind of a steadfast adherence to your objectives and your goals. And we often talk about staying the course, which is very, very important, but most importantly, aligning your portfolio with your objectives, and then using drawdowns such as this for opportunities. And so on the next slide, I just want to point out, this is some of that academic data that we like to point to. And I know the numbers and our letters are way too small to make out, but basically what this is just a series of geopolitical events going all the way back to World War II. And we pulled the numbers of the day of performance, and then a month after, 3 months after, a year after. The numbers don't lie. You often see a lot of volatility when things happen, when things change, just as we're experiencing right now. But if you look on a go-forward basis, the vast majority of the time, markets do recover. And so we could do this analysis across any number of events over any period of time, whatever the magnitude or significance of those events, be it tax-related or war-related, social-related. There's so many things that impact our lives, and the market does take those all into effect, but it does move on eventually. And so this is just one of the many, many reasons why we tell our clients that don't overreact to what's happening in the market. Stay true to your long-term goals and your portfolio, because on the next slide, we have yet some more data that points to what I think is one of the most important lessons any client or any investor can remember when thinking about how important it is to be in the market. We always talk about not timing the market, but having time in the market. And what this chart demonstrates, if you go all the way back to 1979, if you invested just $10,000, you would have $1.6 million today. But if you missed just 5 days in the market, that would decrease by $600,000. That's the impact of missing those biggest up days in the market, which almost always occur within days of the biggest down days in the market. And we saw that just a few days ago. Imagine if you pulled your money out the day on, I believe it was April 9th, when President Trump announced the pullback of those of the tariffs back to 10%. We saw a phenomenal day in the markets. The Dow 3,000 points. If you miss that day, it's going to have really impactful, a notable impact on your long-term returns. And you can see how much that magnifies the 10 days in the market, the biggest 30 days in the market. And that's over a 35-year time frame. So it wouldn't take much to miss those days, but it's really important to stay invested. And on the next slide, yet another important consideration that, we always think this time is different, but, yes, the individual factors are notably different. We haven't had a trade war of this magnitude in quite some time, but the market is used to double-digit declines, right? As this chart demonstrates, going all the way back to 1980, the average intra-year decline every year is negative 14%. And of course, this year we did breach 21% so far. Obviously, we're still early in the year. We went to a bear market, but it's really not that much different from what happens on an almost annual basis. And so despite the fact that on average, the market declines 14% per year, it also, at the end of the year, goes up by 10.2%. So it really, really makes sense to stay the course as long as that portfolio has a risk level that's appropriate with your long-term objectives. And so we can't get too caught up and let our emotions or any other things influence or have our biases impact our investment decisions. And if we move one more slide, here's another way of taking a little more perspective into account. When we think about bull markets and bear markets, yes, the bear markets are painful. There's proven studies that show that the psychological impact of losses is notably more than the euphoria of gains. However, bear markets are also notably shorter than bull markets. In fact, the average bear market is only around 11.1 months, whereas the average bull market is around 4.3 years. And so there's a lot more up times than down times, and catching that bottom of the bear market on a consistent basis is nearly impossible. So this is why we take a diversified approach. I talked about it, and Aya talked about it a few minutes ago. The next slide has what we call our Quilt Chart that demonstrates, the asset class returns going all the way back to 2005. Recently, as going back to 2019, large cap U.S. equities have had a phenomenal run. We see the dark, very hard to read. I know it's small, but large cap equities have been at the top of that list for, 5 out of the last 6 years. And yet this year they're at the bottom, right? So you can't put all your eggs in large cap equities just because it worked in the past. Doesn't mean it's going to work in the future. Having a diversified approach, having some non-U.S. equities, having some bonds, as Aya pointed out, has worked well for investors taking a more balanced approach. They're seeing a little bit less volatility. So the next slide sums up what I'm trying to say in just a few simple words: stay diversified and stay disciplined. Avoid making emotional decisions. I know that there's a lot of some of the policies that have been implemented may be controversial to many. They may hit home a little harder based upon how directly they impact your businesses or people that you know. But it's really important to unplug as much as possible and make sure that your investment decisions are simply, as I mentioned, aligned with your long-term objectives and your overall risk tolerance. And so I think with that, we have one more slide that just mentions, I'm talking about, have your goals changed? Is your goals income, the income paid out on your bonds, on your stocks, and your dividends, on your mutual funds, they're going to stay the same. What's going to change is the price fluctuation. Your yield on a percentage basis might actually go up, but on a dollar basis, it's not going to change. And if your goal is long-term growth, as we mentioned, market goes up more times than not. It's really important to use opportunities as they become available to put new money to work, rebalance opportunistically as your advisor recommends, and of course we're always looking for opportunities to tax loss harvest where appropriate. And the last thing I'll mention, there's a lot of other things, ways that you can take into consideration from a financial planning consideration. One of the things I just mentioned, tax loss harvesting, of course, is an ideal thing to take advantage of in a down market. But Roth conversions when the market is down, is yet another opportunity. If that's an appropriate move that you've talked about with your financial advisor, doing so when the market is down could be an ideal situation. And of course, thinking about making sure you have cash reserves and also taking advantage of other things, like considering dollar cost averaging to avoid making those emotional bias-based decisions. All of these things certainly should be considered. And if you haven't already, I would highly encourage you to have that conversation with your advisor, or I can assure your advisor will be reaching out proactively and having that conversation with you about these actions that you can take. And so with that, I imagine we have more than a few questions coming into our queue, and I and myself would be happy to address those.
Yes, we certainly do have some questions here. First one, as a 72-year-old retiree, how do I best protect my assets while the stock market reacts to headlines? I'm worried I won't have enough time to simply stay the course.
I'll take a first stab at that, and then Aya, feel free to add on to that. It's a very valid question. I talked about how important it is to stay the course, but if you don't have that longer time horizon, making changes at the peak of volatility sounds a lot like chasing returns, and that leads into kind of some of those emotional bias-based decisions because of getting caught up in all of the rhetoric. And things are changing so rapidly right now in terms of the proposed tariffs that are being shot out and then pulled back and changed. And so right now we don't have a lot of clarity. So I think making any bold moves in one's portfolio, dramatically shifting from a equity heavy portfolio to a fixed income portfolio, maybe a very dramatic change that could not work well if the market rallies considerably based on tomorrow's news. So I would probably advise having a very long and hard conversation with your advisor before making any bold changes. But there are subtle things that can be done and things that we're already doing within our portfolios, like looking for ways to incorporate some asset classes that have lower correlation to stocks and bonds, and that those can bring down the volatility in a portfolio. They may not participate with the market quite as much in an up market, but there are non-traditional asset classes and mutual funds and ETFs that can actually hedge some of the equity. And so some of those types of strategies can be implemented in a strategic manner in a way with a specific purpose of minimizing volatility. So I would recommend having a conversation with your advisor about those types of strategies as opposed to anything, a bold shift that would change your long-term objectives. I don't know, Aya, anything to add to that?
Yeah, no, I mean, I was just going to reiterate the point on diversification, right? I think that, when markets are going up, concentrated positions look great. It really isn't until things start to go sour in which you think, oh, I should have diversified. But, diversification in an up market really is an insurance policy for when things turn, right? And so I think making sure if you're revisiting your portfolio, making sure you're well diversified across both stocks and bonds, within both stocks and bonds. I mean, I went through all of those market indices and talked about what large cap did versus small cap. Small cap has had a rough go, but does that mean you should ditch your small cap allocation and not have a small cap allocation? We don't think so. Again, small caps can perform really, really well when things do start to turn. And so having that insurance policy now is for us is a positive thing. You don't have to, have a huge allocation there, but having a holding to reflect that, I think is a positive situation there. So just increasing the diversification during good times in order to make sure you protect things during the down times.
All right, let's move on to the next question. We kind of covered it a little bit, but worth recapping. What is the impact on bonds and treasuries, and how do we ensure some stability in our portfolios?
Again, I'll take the first stab and feel free to add. I mean, it was interesting. We saw, bond yields come down early on when towards the end of Q1 and in the early weeks of kind of the trade war rhetoric. But what we saw after Liberation Day, we actually saw bond yields back up. That's our phrase of meaning longer term bonds are actually selling off. And, there are some that believe that actually had something to do with, the administration's semi-reversal on their policy, or at least their willingness to pause a little bit, because, the administration definitely is focused on the bond market. Longer term, higher yields are really not in our best interest. And I think the administration is very focused on having lower interest rates, both, on the short term as well as the long term. And so I think President Trump and the administration are going to be very focused on that on a go-forward basis. So I think the takeaway is that we have seen some volatility. Bonds have done better than stocks this time around, but I don't think they're necessarily immune. And we did see somewhat of a reversal the last couple of weeks. Aya, anything to add?
Yeah, I'm just going to add that, I think there's been a lot of talk about, the reason why bond yields went up and bond prices went down, especially on the long end, was that China or Japan or somebody was selling a lot of them. And, we won't know, we won't get the data for a while, for another month or two. But, regardless of who was actually selling, when you think about just the overall foreign holders of US Treasuries, they make up about a third of the holders, right? We've got US banks in general that hold another quarter of US Treasuries. You've got, the Fed itself that holds a bunch, probably another third. And then you have US households that hold, 15% or so. And so, when you think about it in the big picture, right? If somebody is selling, yes, on any given day, it could cause some pressure, but the bond market is very, very large. And I think, when you think about who those steady hands are, again, US banks have actually been the steady hand this time around relative to the global financial crisis. And, you still have the Fed, even though they didn't say they would be coming in right now, they did reiterate that should the inner workings, the plumbing of the bond market, if it goes awry, that they would be willing and able to step in. And I think that was also a positive for markets across the board as well when that was reiterated. Next question, Tom.
Okay.
I think
yeah.
One more.
Okay, yeah, absolutely. Last question then. The media projects the tariffs will be either inflationary or contribute to a recession. What are your thoughts?
I can take that one first, Gary, if that's okay.
Go ahead.
Yeah, so tariffs, again, they're a one-time sort of increase in price. And so in the short term, I think, yes, they are inflationary per se. But, when I think about price increases because of tariffs versus price increases sort of during COVID and that post-COVID timeframe, the difference is really in the demand landscape. So both the tariffs and COVID were supply shocks to the economy. And that created, supply disruptions. The tariffs are creating supply disruptions. Companies don't know whether or not to take the shipments that are coming from China and Vietnam and other places. And that part is maybe similar in nature, but it's the demand side that is different. during COVID, a lot of us were just sitting in front of our computers deciding, you know what, I'm going to be able to buy a bunch of new things because I'm not going anywhere. So I need to, redo my home office. A lot of things that were being purchased online. There was a lot of demand going there, and there was a lot of checks that were being sent out during that time as well, kind of fueling that demand. This time around, we don't have that demand tailwind, and so we don't necessarily think that the higher prices are going to last for a long period of time. Now, that leads into the recession part of the question, in which the lower demand really does go into the slower growth that we are expecting. And this is why many people are talking about the longer this lasts, the longer these tariff rates are in place, the more likely we are to go into a recession. Any comments there, Gary?
You covered it so well, but I'm going to just add on my comment that actually I started with. I think it's just all about the uncertainty right now. It's the not knowing what's going to last, if we're going to escalate this, if we're going to pull back. The longer that happens, that's an extended period of time that CEOs and other purchasing managers or people that are in charge of making those CapEx decisions are going to hold off, because no one wants to invest in a new plant or a new company or hire new people if there's the potential for this to get worse. And so the challenge right now is that both consumers and business leaders, and no one really truly knows where this is going to go. We're all hoping that this actually works out really well, and we do get better deals with a lot of the countries that I think undoubtedly did have better terms on their trade, and we can all hope that we walk away from this with a better, more fair, equal policy without actually getting to that 30% tariff level. So I'll second what you mentioned. The sooner we get this resolved, the sooner uncertainty subsides, and the sooner both the market can establish a new baseline, and those that are in positions to make financial decisions can move forward with a higher level of certainty.
All right, well, thank you both so much. Again, that's all the time we have for questions. So anything that we did not get to, again, your advisor will be reaching out to you individually. We will be sharing these questions with them, so they'll reach out to you on their own. Again, this session has been recorded, so look for the recording in your inbox either tomorrow or early next week, or also on our YouTube channel, which again, I'm going to keep plugging until more and more people go there. So please check that out. Gary, Aya, thank you so much for joining us today, and we wish you all the best of luck. Take care.
Thank you.